Let's talk to Neel Kashkari. He is the president of the Minneapolis Federal Reserve. Thank you so much for being with us.
Thanks for having me.
We should also note that your former role was Assistant Secretary of the Treasury, which is how we all came to know you. You led the federal government's high-profile response to the 2008 economic meltdown. You oversaw the TARP, the Troubled Assets Relief Program for short. And I want to know, when you're looking at these forecasts here, you're hearing some folks, you're hearing some observers, you're seeing indicators that are showing recession warnings. Do you think that the economy is on the brink?
Well, the signals are mixed right now, and I'm paying very close attention because we're getting these confusing signals. On one hand, U.S. consumers and families seem to be doing reasonably well. The job market is still strong. The economy is still creating jobs. Wages are slowly picking up, and consumers are still spending. And consumer spending is the bulk of the U.S. economy. So that's all good news so far. On the other hand, businesses are spooked. U.S. businesses are really worried about the trade war, and we're seeing businesses pull back and being more reluctant to make investments going forward. And we're seeing effects of this trade war on Germany and China, so the global economy appears to be slowing. So there's good news in terms of U.S. consumers, but there's concerning news in terms of businesses. And then the bond market is showing signs of potential recession ahead. So, I mean, I'm paying very close attention. I know all my colleagues are. We don't know yet. Are we headed for a recession? That's not my base case scenario, but the risks have increased quite a bit.
So you said yesterday you're leaning toward more stimulus. Is that just as an insurance policy? Explain to us your reasoning for that.
Well, one of the things, in the news, it gets a lot of attention, this thing called the yield curve, where long-term Treasury interest rates are lower than short-term Treasury interest rates. Usually it's the opposite. If you loan your money to the government and you tie it up for a number of years, the longer you tie it up, the higher the return you expect. So now that people are lending their money to the government and expecting a lower return, that itself is a signal to me that interest rates right now might be too high, that the Federal Reserve might have interest rates too high given the underlying fundamentals of the U.S. economy. So that's where I'm leaning right now, saying that we probably need to go ahead and pull back on interest rates to provide more support to the economy. But we need to continue to watch the data as it comes in over the next month before our next meeting.
So is part of this about doing something right now, taking action early, so that something isn't worse later? And when you think of that, are you looking at our most recent financial crisis as a cautionary tale in that?
It is. I mean, I think we've learned from the most recent financial crisis, but also the experience of other major economies around the world, that it's much better to be early and aggressive in responding to a slowdown than it is to being late to it. I know back in 2008, during the intense financial crisis, we were always late. And that's because we weren't sure how bad it was going to get, and that ended up making things worse. I mean, we have to admit that. And I think now, interest rates are already quite low relative to history, and that means we don't have as much room to cut rates. So we don't want to go back and hit zero and then have, somewhat be out of ammunition or have less ammunition. So in that environment, it is better. I think people around the world have learned it is better to be early and aggressive if you see a slowdown than wait until you're sure the economy is in recession.
Do you think, as we look at some of the criticism over and over the president has had for the head of the Federal Reserve, Jerome Powell, that it's fair for the president to be taking aim at him for problems with the economy?
Well, I think, first of all, let me just say Jerome Powell is an outstanding Federal Reserve chairman and an A-plus public servant, and I think we're all lucky to have him and completely support him. Look, I've been critical myself of some of our interest rate increases. I have argued historically that in the recent years they were not justified by the data, and I think that that is still true. So I think that there's some truth to that. But right now, when we talk to businesses around the country, businesses are mostly concerned about the trade war, about the slowdown in the global economy. Very few businesses that I talk to are pointing to the Federal Reserve and saying, hey, it's your interest rate policy that is slowing things down. Much more likely it's focused on trade policy and global uncertainty and global anxiety. So I don't think that that part of the criticism is fair.
All right, Neel Kashkari, thank you so much for coming on.
Thanks for having me.